Good afternoon, everyone. I'm back here again. I'm 𝗪𝘃 from iFAST Research. And in the morning, if you have followed our presentations about the new Asian tigers, you probably have known that we are pretty optimistic on Singapore. So let's now zoom in into greater details on why exactly we like Singapore. So before we begin, let's give ourselves some refresher on what has happened in Singapore this year so far. So firstly, the STI is up 2.26% year to date. Have you invested in this index? If you do, congrats. Your investments are in the green, at least for now. And next, as you know that higher costs actually hit us this year, especially with the GST hike from 8% to 9% and since the beginning of the year. And to measure this, when we look at the CPI, you can see that although it has cooled down from years back, but it's still sitting above the 2% rate. So which means that we are going to stay in a higher for longer interest rate environment for a longer time. And next, the tourism industry in Singapore. So Singapore's international visitor arrival numbers in the first quarter actually grew strongly by 50% and amounting to 4.35 million. This could be due to a couple of reasons, and the first one is the popular Taylor Swift Eras Tour held in March, and I'm sure many of you have attended it, right? And also, the mutual visa agreement signed between China and Singapore. So the Eras Tour held actually had about 300,000 concert goers, and 70% of them actually flew in from overseas. And other than Eras Tour, actually there are some more famous concerts held in the first quarter, includes the ones from Coldplay, Ed Sheeran. And this is also estimated from the clock that each concert goers that flew in from overseas, they are going to spend an extra $800 on accommodations and in restaurants and also other experiences. But as the concert industry recovers from the COVID impacts, we are going to see more artists flying into Singapore and hold their concerts in Singapore. And this will continue to drive the growth in the tourism industries in the following years. We also notice an uptrend in Singapore's international tourist arrivals. It was worth noting that actually prior to the pandemic period, between 2016 to 2019, actually, the majority of, and we say a bulk of the investor come from China. But as we know, China locked down for a prolonged period compared to other countries, and Indonesia overtake China to become the countries that with most of tourists coming to Singapore. But with China reopened last year, and this year, Singapore and China has signed a mutual visa exemption agreements. We have seen that more Chinese tourists coming into Singapore, and this will help Singapore to generate more tourist receipts and push its economic growth for the lion cities. And what does they mean for tourism industries? Room rates and also hotel room revenue increased significantly in 2023. And compared to pre-pandemic levels, they are actually quite comparable. And the Ministry of State for Trade and Industry and 𝗪𝘀 has also estimated that total international tourists visiting Singapore may reach between 15 to 16 million, which is about 80% of the 2019 levels in 2024. He also expects that these tourists who spend another SGD 26 billion to 27.5 billion in tourism receipts in 2024, which is about 94% of 2019 levels. Next, we look at the housing market here, and in particularly the hot resale HDB market. And this year, we are seeing once again more HDB units join the SGD 1 million price tag. Looking at the graph on the right, you can see that HDB resale price index is still on an upward trend, and as seen on the yellow lines, despite growing at a slower rate as noted in the blue column and beneath it. This shows that the demand for resale HDB remains very high, and due to a couple of reasons. So first is the construction delays brought by COVID-19. And as well as owners actually who look to downgrade from ECs to HDBs as they would have recently fulfilled the requirements of 15 months without period. We have also seen HDB recently pushing out a new strategies called HDB Resale Flat Portal in the hopes for owners to market their own flats. And this will potentially improve price transparency and potentially lead to greater property transaction volumes. And this will probably generate more loans for the banks and benefits the bank's growth in Singapore. And last but not least, this year we have a new PM, and I'm sure everyone knows about it. And he has already shared plans about elevating Singapore's position as a digital economy, as well as the Singapore's strategy as Singapore's national AI strategies. So during the Singapore conference for AI that was held last year, Mr. 𝗪𝘆𝘀 have already introduced the updated National AI Strategies 2.0s. And he focuses a lot on the talent nurturing and fostering a thriving AI industry in Singapore, as well as supporting with leading infrastructures. So this new initiative aims to triple Singapore's AI practitioners to 15K through the investment in reskilling and upskilling our workforce. And in March this year, there are more updates has been shared that the government is going to invest another SGD 20 million for AI practitioners, for training for students, as well as scholars for local undergrads, masters, and PhDs. And additionally, there's another funding up to SGD 500 million that will also be used to fund resources and invest in infrastructures that were used for AI, such as high-performance GPU for sectors including financial services, healthcare, transportation, as well as logistics. Also, we have seen a great collaboration between NVIDIA and is underway to develop AI large language models for Singapore. And the company's CEO, Jensen Huang, he has also expressed optimism that his intention to build a large supercomputer in Singapore. We have also seen more AI news on the way, such as Amazon is looking to invest another 12 million here to expand its cloud infrastructures and launches AI training schemes. And overall, all these good efforts that will continue to drive Singapore's journey towards building an extremely digitalized economy. So now we have already recapped what has happened to this year thus far. So what can we expect for the rest of the year? As you have heard, we are very positive on Singapore's economy, and this is largely due to the tech sectors. So to provide some background, we know that actually a significant portion of Singapore's economy's growth stems from its export, and with a notable focus on electronics. And this underscores the importance of closely examining the manufacturing sector and especially the semiconductor industry in Singapore. So we anticipate that there will be a pivotal moment in the global semiconductor space. And this has been shared by my colleague 𝗪𝘀𝘀 earlier on how we are expecting global semiconductor industry is going up and up cycle. And thus far, we have projecting a 35% year-over-year growth in chip sales by the second quarter of this year. And this forecast is actually underpinned by the expectation that chip makers will experience a structural surge in demand as the world becomes increasingly digitalized, potentially, and will result in increased semiconductor applications and higher silicon content. And despite this prevailing sales downturn, we anticipate that adjustment in the production levels, also there'll be more government initiatives and base effects. All these will contribute to the heightened future sales growth of the semiconductors. And these factors are going to continue to propel the growth and adoptions of AI in Singapore as well as in the world. The Lion City also play a crucial role in the global semiconductor industries. Many of you may not have realized that actually Singapore is a very active player in the downstream semiconductor industries. And Singapore holds a significant 20% share of the global semiconductor equipment market. And there are some signs of recovery in the Singapore's semiconductor industry in January this year. So for example, electronic equipment exports increased by a positive growth of 0.7 year-on-year growth. And this is a great improvement if you compare with the private months of result, which contract by 11.7%. And the country's manufacturing output has also grew with precision engineering growing by 27.7%. And due to higher productions of front-end semiconductors and process control equipment. Both electronic export and manufacturing's output continue to expand 5.2% year-over-year and 3.8% year-over-year in February. And however, Singapore's electronic exports and manufacturing output slipped in March. But despite this, the manufacturing activities under precision engineering continue to expand. So while March electronics exports, the news and the facts and export figures are not so encouraging at this moment, but we believe that electronic exports and manufacturing output will be more stable in the coming month. With the recovery of global semiconductor sales and driving a substantial increase in electronics demand, the electronic sector is poised to drive Singapore's export growth. And also known for its political stabilities, prime geographical locations, and bilingual populations, Singapore is a key bridge between the East and the West. So another driver is China's +1 strategies adopted by companies actually to promote greater geographical supply chain diversifications beyond China's. Semiconductor giants like Taiwan's TSMCs, Vanguard International Semiconductor Corporations, and even global foundries, they have already pursuing expansion plans within Singapore. And the nation is becoming an attractive hub for global semiconductor giants to expand their businesses if they want to venture into the Southeast Asia regions. Moreover, Singapore has obtained a niche in specialty chip productions and thereby aligning with the trends in 5Gs, automotives, and also the Internet of Things. So being a key bridge between a East and also a West, and so as being well known for its tax incentives, many tech giants like Meta and even Google have regional headquarters here. And this could suggest that companies view Singapore as a strategic gateway to Southeast Asia. With an anticipated robust recovery in Singapore's GDPs, we also foresee a potential uptick in investor sentiment. And this could lead to an inflow of capital into the country's equity market, and in return, trigger a re-rating and drive valuation upwards. So first, we see that long-term growth for Singapore banks. Singapore banks, actually including the top three, DBS, UOB, OCBC, are valued for their long balance sheet as well as attractive dividend yield. So the long-term growth prospects of Singapore banks are supported by several factors. And this includes potential for the expansions abroad, driven by the excess cash positions. And they are also considering acquiring other banks in Southeast Asia to broaden their customer base, as well as to stimulate further growth within the companies. Furthermore, the banking sectors is expected to benefit from foreign direct investments and a growing presence of family offices, which could boost the company's non-interest incomes as well as increasing wealth management fees. So Singapore's stable economies, highly educated populations, and supportive policy for family offices, all this will make the country to grow further in the coming years. And we can see that actually the 𝗏 have recently reported SGD 5.48 combined net interest income in the first quarter. And this marks the 6th consecutive quarter that is coming above the SGD 8 billion. So DBS and OCBC actually exhibited strong growth in the first quarter. And this is mainly supported by the strong diversified revenue engines, including higher fee-based income, trading profits, as well as treasury sales. And although we have seen that rates probably might have peaked, but they are able to maintain their net interest margin at a very stable levels. And UOB, compared to the other two, face greater pressures in this sense. So in that sense, we see that overall the banking industry is stable in the first quarter this year. And we believe that all these three banks can continue their upward trend in terms of revenues and net incomes. We believe that they can do well in the coming years, because with the persistent inflation in the US and also a robust economy in Singapore, we anticipate an extended period of elevated interest rate environment. And such an environment typically favors financial institutions like the top 3, which are well equipped to navigate the net interest income compressions through diversified revenue streams, stable deposit inflows, high quality assets, and ample liquidities. And therefore, we maintain a very optimistic view on the bank's performance in 2024. So finally, for my last slide, we find investing in Singapore a very attractive option, and this is due to its position as a key semiconductor hub and also the broader economic recovery that might trigger a potential uptick in investor sentiments. So this could lead to increased capital inflows and in return trigger a re-rating in the equity market and drive valuations upwards. Meanwhile, the long-term outlooks on banks and the largest sector in SDIs remains supportive. So for those who are interested in our local market and wants to take part in the growth of Singapore, you can consider the Nikko AM Singapore SDI ETF, which offers actually the lowest expense ratios among its peers. And also it has a very low tracking difference to the index. So that's all for my presentations on Singapore. Thank you today.